It is February 20th, 2025. And, every year I say this, but this is the best start to the year I've ever had. I doubt next year we'll be able to match this, but I said that last year. And here we are, right? Thank you, Baba, right? You never know when they're going to work. Just know that they are. And you try to get that ROIC in line and make it work, right? Um, so I'm going to run through this document. I have a YouTube video on this document that we created in the past. So I'm going to try to get through it a little bit quicker so we can get a little bit further this time. Um, but I like to start out by saying, hey, this is the most important thing about this subject. So, like, do you guys remember what the most important thing I wanted you to learn about technical analysis? You want to remember when we created that document? What was the most important thing? Yeah, exactly. The market makers, they use technical analysis to take your money, right? That's literally what they use it for. Everybody knows technical analysis. It's not like it's this secret sauce anymore like it was when it first started. They literally use it to take your money. Okay. Now they don't do it all the time. Otherwise, it wouldn't work when they did it to take your money. But that's the main thing that you should understand about technical analysis is you need to be prepared for the failed breakouts and the failed breakdowns because it's used often. Um, yeah, I am recording. So now to shift that into value investing, anybody take a guess at what is the most important thing? I've said it a number of times. The way that I invest, the way that I like to do things, it doesn't fit 100% of the time. But what is the most important thing? Yeah, earnings runs the market, but what's the most important thing for earnings? Yeah, you need to know what you own. Yep, that's all that's true. Yeah, John got it's free cash flow. It's free cash flow. Everything else kind of comes after that. You guys know what free cash flow is? So if you don't, all you have to do again is you can always look up free cash flow Investopedia, and there you go. So free cash flow report represents the cash that a company generates after accounting for cash outflows, right, to support its operation and maintain its capital assets. So if we pull something up here, AI um, is great. And if you want to know the difference between something, just pop over and say, hey, what's the difference between EBITDA and free cash flow? They serve different purposes and measures, different aspects of a business. Let's break it down. And then you can go through and you can say, hey, here's the differences. Oops. See, I got AIs all around me. Siri's trying to talk to me now. Okay, so just looking at this chart, you see the difference between EBITDA and free cash flow and why Warren Buffett said EBITDA doesn't mean anything? Why it's not that important. Anyway, so free cash flow. Now, first thing to understand the value of any investment is the present value of the future free cash flows that are going to come in from that investment. Does this make sense? Does anybody have any question on this? Because this is it. This is like this is the golden rule. I don't know how else to say it, but like what we're doing when we're looking at a company is we're going in and we're like, all right, this is how much money this company is going to be bringing in the next whatever, how many ever years, and this is what I think its value is worth now. Has anybody ever created a pro forma? Put a 2 in chat if you've owned your own business. Have you ever owned your own business? No, a lot of times when you're trying to get loans, you got to put in pro formas for your bank. And what they want to know is how much money you're going to be making in the future. Make sure that you can pay back the loan, right? Um, so there's a lot of ways that people try to find the value of companies. Some people like growth. Some people like history of consistent earnings. Some people like a strong cash flow. Does anybody know who Peter Lynch is? So if you look up and read that book, One Up on Wall Street, and you can if I do a quick Google, do a quick Google search, what are what are Peter Lynch's ratios as he looks for companies to invest in? Well, he likes to have a PEG ratio under 100. I'm sorry, under one, ideally as low as five. A PE ratio less than one is poor. Yeah, this isn't right. So this is a summary. So it yeah. I only know this because I've read the book and I understand what he's saying right here. What he's saying right here, this isn't right, but what he says to do is this link it? Yeah. Here's the full saying. Where is it? There it is, right there. This is the whole thing. That what they were saying before. So he says, hey, I like to find the long term growth rate, add the dividend yield, and divide by the PE ratio. Less than one is poor, 1.5 is okay, but you're doing really good if you're looking for two, right? So, this is just one of the ways that he presents value. So here, if we were to use BABA, um, dividend rate of about 5, uh, long-term growth rate probably I would say it's between 8 and 13. So let's just go with 10. So that would give us 15. And then the PE ratio, remember what the PE ratio was? It was about 12 to 13. So let's just say 12.5. So that gives us 1.2, right? So that's him saying, all right, this is one that maybe we want to take a look at and we can build a story on, right? So you can go through and you can look at whoever you want, Peter Lynch, Warren Buffett. You can find out what these people like to look for, um, to decide how they decide value. Um, the key ratios, book, equity, that, yeah, we'll get into. Now, when I was looking for a business before I got into day trading, I owned Subways and Sport Clips. I've got a picture of me. One of my PowerPoints. I don't know exactly which one it is, but I'll look for it later. But it's a picture of me in front of my Subway saying, grand opening, and I'm probably 27, 28. Um, and what I was doing, what I was looking for is I was trying to figure out, hey, how much money are we making and or losing? So like I bought 12 sport clips, all of which were losing money. I never bought a Subway that wasn't already making money. So how do you determine how much these things are worth? See the revenue of said business and profits. Now, when I looked at the revenue of a Subway, I knew how much money I could make versus how much money they were making. So some Subways are run poorly as companies. What I did here was I would create, if anybody's interested in owning a Subway, this is all you need to figure out how much a Subway is worth. Actually, shrink this. Can you guys see? Shrink it down a little bit. Can you guys see total yearly income down here at the bottom? Okay, you can. Okay. So what we do here, this column right here, this B column right next to yearly net sales, right? That's how much revenue they were bringing in. So for this particular one, example A and example B, you've got revenue of about 500,000 versus revenue of about 880. Now, how much more is that? Like, what percentage is 880 compared to 490? Anybody good at math? Anybody figure that out? So it's 330,000 basically more. So if you were to put that into you're to put that in, think of it like the way that I do things is think of this as like a million, right? So if it's 500,000 and it's doing 330, just double it, right? And so it's going to come out to about 60, give or take 5%. Let's see. Let's just take 500,000. I think it'd be near 65 equals plus 500,000. Bam, there we go. So about 66%, right? Yeah. How much does their yearly net income go up? You guys see the difference here? So we only go up 66% in revenue, but what happens to the percentage of yearly income? Yeah, it's well over 100%, right? Now, in business, this is called something. Does anybody know what this is called? And maybe I'm not giving a good enough definition here, but there's a certain amount of expenses that need to be covered. And the more revenue you go up past this point, your income actually increases. So the way that it works with Subway is the magic number per week is about 7,500, or it was 20 years ago, or whenever I sold out. 7,500. That number would give you, let's see, times 52. Once you get over 400,000, right? That's what you want to get to. And at that point, let's see. You're going to be making above, I think it was 14 cents, right? Per dollar that you bring in. But the magic number that you wanted to get to was 10,000 a week. Once you get to 10,000, you really start ramping it up, right? And so there's these certain inflection points that really begin to push cash higher. And this is what makes certain ratios harder, especially when you're looking at growth, et cetera, et cetera. So on this subway, on this one on the left, this is all the expenses. DAI is Subway. They take out 12.5% just off the top for advertising and royalties, your rent, labor, food, blah, 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 blah. Then at the end of the day, this is what you have left. To determine the value, the multiple that you need to sell it at, it's ultimately what it brings in. Do you think the one on the left is worth 2 times sales or 4 times sales? You think the one on the right is worth 2 times sales or 4 times sales, right? Which one's going to give you a higher multiple and that you'd be willing to pay more for, the one on the left or the one on the right? And this is we're literally looking at businesses and going to invest in them. And the answer is the one on the right. The one on the right is for sure the one that you're going to pay a higher multiple on. Now, depending upon the market, I was in 3 different markets. Some markets would go between 2.5 and 3. Some would get as high as 3.5, and rarely you would get above 3.5. So what I would say is, all right, this one on the right, if I can get it between 2.5 and 3, I want it. And then I would negotiate. I would say, all right, well, we got a remodel coming up in 2 years. That's going to cost 50,000. Let's split that. I'm going to take out 25. You take out 25, right? And then you kind of get down to the nitty gritty. But ultimately, what we want to do with stocks is we want to do the same thing. Is we want to come in here and we want to say, how much money is this making? How much free cash flow is it giving? And how much will it be giving in the future compared to what I'm going to do with it under management versus what the previous owners were doing? Because some owners wouldn't run their food costs. You see this food? Some owners would run food costs at like 40%. I could get it as low as 28. I don't know about now, but that's the number that I would use. So what's one thing that just that example that I gave you, how could we apply that to a investment into a stock? So one of the things that I look for is exactly what I just said. Do you guys remember when I got into PayPal? You guys remember when I got into BFC? You guys remember when I got into Disney? All of these have a common thread about, I literally just said it. What was happening? Yeah, you got a new CEO coming in. So the other CEO was like, man, I can't get food costs below 35%. It's not possible. You board members and stockholders, you guys are crazy. And they're like, well, see you later there. And we're going to bring in somebody that can get food costs down, and we're going to save 5%. We're going to increase our margins by 5% because you suck. And well, what does that do? Well, it leads to, I can find it. Yeah, here we go. So, do you guys see this free cash flow right here? That's what this is measuring. This is Stanley Black and Decker. So Stanley Black and Decker had a 1, 2, 3, 4, 5, 6 periods here where they were having negative free cash flow after strong free cash flow for a long time, right? So what you want to find when you're looking for companies to buy, real estate to buy, stocks to purchase for investment, is you want to look for things that have temporary impairment. For whatever reason, this impairment has shot it down. And I believe in the future it's going to go back up. Does anybody know what Stanley Black and Decker's impairment was? I don't know if anybody's in this still, but ultimately they got full of inventory. COVID hits, right, and it causes a lot of problems. The temporary impairment on Baba was the government was going after them, right? The CPP was like, screw you guys, you're getting too powerful. So you're always looking for this temporary impairment. Disney, for example, you can think of a ton of different, hopefully temporary impairments. Some people don't like the woke aspect of it. Some people didn't like the new CEO. Um, some people didn't like the starting out with the Disney streaming, right? The cost of that. Some people didn't like the ESPN acquisition. So you're looking for companies that have these temporary impairments. And so the reason that I was ready to buy and willing to buy the sport clips that were losing money, each sport clip would lose about between $5,000 and $15,000 per month. And so why was I willing to buy those? Well, it's because I knew once I got in there, things were going to change and I could turn it around. So on PayPal, when we came in and I was looking at this free cash flow, trying to get it so you guys can see the number here. I don't know if you guys can read that, but would you guys like to own a company that has free cash flow of $8 billion? Well, I would if the price is right. I would love it. $8 billion free cash flow? Wow, that's crazy, right? What do you think the company's going to do if they're bringing in that much cash? You know, what do you think you're going to do? Yeah, exactly. You're going to buy back stock. You're going to create a dividend like Baba. Baba knew their stock was so cheap. You guys know what they did? Does anybody remember this? And everybody was freaking out about it. They literally borrowed money to buy back their own stock so that they could sell that stock, take the money that they borrowed, pay it back, and then make money off of buying their own stock, right? So if you're buying back $15 billion of PayPal, let's just do some quick numbers. What's PayPal at right now? What's the stock price? Let's just say they did. Let's just say they used $80. What's 15 billion? What is 15 billion divided by 80? $187.5 million shares. All right, well, let's go back and let's look. How many shares does PayPal have? How many shares are out there? Looks like yeah, about 980, right? So just simple. Let's just again to make the number simple. It's not exact. So let's just say it's 1,000 million. So a billion shares. if they're going to buy back, let's just say 20 million shares, I'm sorry, 200 million shares, how much of the float are they buying back? Yeah, 20%. That's right. 20%, right? Wow. So if they're going to be buying back 20% of their company, man, their free cash flow looks amazing. They're starting to crush it. Maybe PayPal's something I want to look at. And then you start building the story, right? So there's quite a few different websites I use, and I'll give you a list of those. All of them are paid. Um, at the end of the lesson, you know, there's no one right. I'm sure you can get it all for free somewhere too, but you know, I don't know if you guys have heard of Poifin. I don't know what you guys know, um, but once you find the numbers and say, hey, this is what I like, and you start building the story. Well, what if PayPal's got whatever a cajillion dollars in debt? Is that something that you'd want to be a part of? Debt to income ratio. And so what you want to do, and I'll never give this out for myself because the edge would stop working, but what you want to do is create for yourself a list. I want a PE ratio, just like we scan for stocks. I want a short float above this. I want a PE ratio here. I want a growth rate here. I want a debt to equity ratio here. I want a PEG ratio here. And you start leveling these things out, and then it brings in the companies. You'll get a list of whatever, a couple hundred companies that fit within your scan. And then you start building the story. Okay. So once you have a total of what you're valuing, whatever the company is, right? Um, then you have to take the price at which it's selling to figure out which one's going to give you the best deal. And I'll give you an example. So I am long-term GXO, right? I am long-term BABA. Now, which one do you guys think I had more money in, GXO or BABA? Well, BABA. BABA was my largest position. And so, why? Well, because BABA has in my opinion, the better story behind it with the chances of the higher return. Now, why don't I just put all my money into this? Why didn't I just say, hey guys, I'm just putting in every single penny I've got into BABA? Because I have rules, right? Rules. Number one rule is this: never buy such a large position that if it goes to zero, I am out of the game. That's my number one rule, right? Now, I'm going to say something that's going to sound really cocky, but it's true. I've never been wrong on investing in the stock market. I've been wrong on investing in life. Absolutely, I had to throw away a couple $1 million on a store I tried to do with my brother, and completely wrong thing to do. Don't ever do anything with your family. Just my advice. However, within the stock market, I've never been wrong. As far as investing, I've always hit it. Maybe it takes 2 years, 3 years, like Baba. And some people have the saying, if you're early, you're wrong. In that case, maybe so. But I've never had an investment not give me 33% ROIC, which is greater than the greatest investors that you know. Would I be able to do this with the money they manage? Probably not, right? Like Pepper's my hero. He does around 30 to 33%, and he's the best one I've ever seen. He does it with Right? I do it with small fish. So if I've never been wrong, shoot, I should just pick the best one and go at it. Well, no, because I'm eventually going to be wrong. It's going to happen, right? And I don't know when it's going to be, but I will be wrong. And so, as the number one rule is invest what you can. And if Baba went to zero, guess what? I would have lost a lot of money. But I wasn't out of the game. Here's another rule that I forgot who told me this one. This isn't mine, but I've heard it somewhere. Rule number 2. If I wanted to buy a Subway or Sport Clips or whatever, the I don't know, the mom and pop shop down the street from you, how would you go about doing that? What do you do? You go into the store and you're like, hey, can I talk to the owner? And then what do you do with the owner? The thing on screen is just my document that I started to create for value investing. I'll share this with you guys too. So literally, you walk into the store and you say, "Hey, Billy Bob, I love this gas station. I fill up here every day or every week. I buy my coffee here every morning. I think I want to buy this from you. How about I give you 100,000 or a million or whatever you think it's worth?" Well, how do you do that in the stock market? How did Elon Musk buy Twitter? What do we do? Anybody know how to buy a company? Yeah, yeah. You literally gotta go in, right? And you say what? What did Elon Musk say? I'm going to pay you this much money for the company. Your company is worth this much money, which equals out to this amount of shares. So the rule here is do not buy a company, or you could reverse it. Only buy companies where if you walked in and you offered them the current price for their company, they would laugh you out of the building. So do you guys remember when I was talking about Baba before this run? I was like, guys, they're producing 30 billion. They're sitting on $80 billion in cash. They're buying back 5% of their company. So just that in of itself is equal to about 150 billion. The market cap of the company was like 172 billion. So I was like, what do you guys think they would do if I went in there and was like, hey, I'll give you $200 billion for Baba? What do you think that the board and everybody else in that building would do if I walked in and said, I'll give you 200 billion for Baba? They probably call the police, lock me up, and call me crazy. So only buy companies where the price is laughable if you were to offer to buy them out at current price. Here, let me give you an example. How many of you guys were trading when this company was trading? Does anybody remember NKLA? So I was with another group with Nate when this was going on, and they would always have the CEO come in and talk, and I told everybody then, I said, this is a scam. Don't touch it, short it if you're going to do anything. The guy's a creep and he's a scam artist. Well, how did I know, besides what the writing on the wall, if I would have gone in and offered him this amount of money, that he would have taken it? What's one dead giveaway? Yeah, Trevor Milton. What's a dead giveaway? Anybody remember this company? same same thing here. Well, yeah, stock offering, sure. But what you're doing when you're doing a stock offering is you're actually finding investors that are willing to pay that amount. So literally, what happened here on Beyond, and I don't know how many of you guys were trading back here or not, but BYND just skyrocketed, and there's a rule where insiders can't sell for a certain period of time. Does anybody know these rules about IPOs? What is it? 160 days? Is that what it is, or 6 months? I forget what it is off the top of my head. But Beyond literally somehow, I forget. I have to go back and read the story. Somehow finagled it where all the insiders were able to dump. All the insiders were like, "Man, this just isn't worth this much money. I've got to sell." So they finagled it and they dumped, right? And so there's obvious tells when things are happening. And I don't know, have you guys heard of a guy named PLTR? I mean, a company named PLTR that a the founder and CEO just decided he was going to dump, I think, 1.2 billion shares, or yeah, 1.2 billion. Or I don't know. That's the report. So this makes people cautious. Does this mean he doesn't believe that it's going to go higher? Maybe not. Maybe it doesn't. But man, that puts a question in your mind, right? If he's willing to sell so much, wow, that makes me question, right? Now, AMD, guess what they do a lot of? They do the same thing. AMD dilutes through employee programs a lot because they never were able to pay their employees as well as the likes of Intel and everybody else because they didn't make the money that they made. So that the way that they made up for that was giving stock to their employees. So when I see Lisa Su sell, it means a whole lot less than when this guy sells, right? And that, again, that's just developing the stories for your value investing, right? Understanding the company. Okay. Um, see where we got to here. Yeah, I'll share this. To create a discounted cash flow, you need an estimated discount. So this is going to explain to you how you can create a discounted cash flow formula. Yeah, it talks about the estimate of the cash flow. Okay, so the third piece of crucial information is called terminal value. This is a very important concept to understand. Estimating this somewhat accurately is crucial to a successful discounted cash flow model. The forecast period is usually 3 to 5 years, and it's easier to get somewhat accurate levels of cash flows based on historical data and proactive forecasting. However, after the forecast period, you need a constant rate of growth you believe the company can maintain to complete a discounted cash flow model. So the things that determine this, it's going to really affect your net present value. Perpetual growth method is used in academia assessments of value, whereas the exit multiple method is more generally used by the industry practitioners because they like having a real life observed transactions to anchor their methods against it. So, real transactions involving comparable companies serve as the basis for the exit multiple method. Has anybody had a picture of their house be taken and you're like, who are these people? And you go out and you talk to them and they're like, oh, we're selling a house up the road. We're trying to get the value of this house when it was sold. You start comparing things, right? This is your terminal value. And so if you have a company that's growing at 30% and you've got a company growing at 10%, Who's going to be bringing forth more value in the future? Yeah, the 30%, right? They're going to be worth a lot more. And so, you remember who's worth paying a higher ratio for? Is it this one or is it this one? Well, it's this one. They're making more money. They're growing at a faster pace, and so your ratios are going to be different depending upon whether you're a growth company, whether you're a value company, whether you're, you know, bringing in 30% revenue per year, year over year growth, or 9% or 8%. And this is just a sector PE ratio, that shows general areas. So if you're buying a technology company and you're paying 22, that may seem like a lot for energy, but it's really not for technology. So can anybody tell me what is the PE ratio approximately right now for the S&P? Does anybody know? Yeah, it's approximately 23, right? What is it historically? It's about 22, 23 right now. What is it historically? Yeah, it's about 17, 18, right? Now, when we think of investing, does that mean we do not want to invest in the S&P right now? How can I make an argument to say that, yeah, historically it's at 18, but I should buy it at 23? Like, think about it. You're literally investing your money. And so, rule number 3 here for me, I'm not going to do this, but it's still rule number 3. Only invest if you are willing to invest 100% of your money. Now, what does that mean? If I had to invest 100%, I feel safe in doing it, right? Would I feel safe in investing 100% of my money with the S&P at 23? Not so much, right? It's like, However, I would love it at 20, maybe a little bit higher, 21, maybe. Well, why? Why am I willing to pay up? Can anybody tell me? Why am I willing to pay up at 20 versus 18? What makes me think, yeah, if I could buy the S&P at 20, I'll put 100% of my money in. So again, this is the story, guys. What is different about now versus even 20 or 30 years ago, especially 50 years ago, 60, 70? What's different? Why is it okay to have a higher PE ratio now compared to 50 years ago? Okay, well, let's look. Where do you think most of our money comes from now? Look at the technology sector. Look at the energy sector. Look at the comm services, right? Like, we're not a manufacturing economy anymore. We are a service-oriented economy with technology that has higher margins, that has higher growth rate. And so S&P 50 years ago is example A. That's why they're only getting a 2.5 multiple. And 50 years ago, S&P A versus S&P now, an example B. Well, I'm willing to pay a higher multiple. We've got better companies that have higher margins, that are growing faster. Does this make sense? And so when you're investing, you always have to compare not just these ratios. The ratios are your search to narrow things down. But once you start getting the ratios and finding the companies, you have to tell the story. More Fed driven? Yeah, maybe. Anyway, I hope that makes sense. Okay. Well, we've got a few more minutes here. The higher a company's PE ratio, the higher proportion of net present value compromised with potential future earnings. Um, I tell you one thing that I do use, and that is extremely important to me, and it's the PEG ratio. So you guys, you can do some search to figure out what's a good PEG ratio. Um, but does anybody know what the PEG ratio is? You guys need me to explain that real quick? We can pull over PEG ratio versus PE ratio. And if you don't know these things, you can just PE ratio is price to earnings, and then PEG ratio is price to earnings to growth ratio. Both are valuation metrics used to assess whether a stock is overvalued or undervalued. Here's a breakdown of how each of them do their thing. So what you'll notice is PEG ratio, it's in growth rate, right? And so I want to know what a company is growing at so I can value their I'm not just using a PE ratio, I'm using the growth ratio as well. Um, okay, I think I've gone through this sheet pretty well. And okay, so there is that. Does anybody have any questions? We need to do this probably 4 to 5 more times to complete a value investing session. Like what I'll do is I'll just keep recording these things, and then we can put them together like a playlist on YouTube, and then we'll have something that we can watch, so that'll be continuous. Um, okay, so before I stop this recording, any questions? And again, kind of the golden nugget here for right at the end. What you want to see, one of my favorite things to see and look for when I'm digging into these things is I want to see free cash flow taking a hit, figure out why they're taking a hit, and figure out if it's temporary and if they can recover from this temporary hit. Because usually what happens is free cash flow will start to recover, and price does not recover until free cash flow recovers. And so what you'll see is something like on PayPal, where I'm like, all right, yeah, they're going to be doing $7 billion of cash. That this is what I knew right here. Well, other people didn't know that because they hadn't done the earnings to show it. Now they have, and it's pushed up. Well, literally what just happened on this last earnings report is the CEO said, hey guys, what we thought we were going to do this next year, we're actually just a little bit under that. Now, if I wasn't aware of the story of PayPal and understanding how this CEO does things, he's called the sandbagger in chief. He's simply lowering the expectations for him for the rest of the year, and we're going to get that because he's going to beat handedly uh, what he put out there, right? So look for free cash flow that's taken a temporary hit. Same thing with margins. It happened on PayPal as well because when margins start taking a hit, you start getting re-ratings. Start looking at CapEx as well. Why is Microsoft and Meta going to be worth less? Well, ultimately, it's because of the email that I sent you guys where notes, this right here. What company do you think is worth more, and do you want to own a company that is spending this much on CapEx or this much on buybacks? So all the money that the Mag 7 are making now, they're no longer doing buybacks, and they're no longer running lean, mean machines because we're not looking for a recession. They're investing in the future, quote unquote, hopefully to dominate AI. And so their CapEx has gone through the roof, which means their buybacks are shrinking down, which means less money in your pocket, which means a re-rating of the Mag 7, which means the S&P 500, which is trading at 23 times multiple, also is going to take a hit because the Mag 7 are going to take a hit, which is heavily weighted towards the S&P 500, which is why I personally am buying the RSP versus the S&P. See how everything kind of fits together? Anyway, all right, I'm going to stop this recording.